Meta just reported solid first quarter, but is steady and AI remains their main focus. But here's the real question. Is the stock price still reasonable, or has it quietly moved into overvalued territory? We keep hearing about growth and innovation, but fewer people are talking about the actual numbers behind the story. In this video, we'll unpack Meta's latest performance, look at what's driving the business, and calculate its fair value based on real data. This is not financial advice. No buy, sell, or hold recommendations. Always do your own due diligence. Alright, this slide shows us exactly where Meta's ad money is coming from. No surprise, the US and Canada are still the cash cows, pulling in around $18.2 billion this quarter. Even though that's down a bit from the Q4 2024 holiday peak, it's still Meta's biggest revenue driver by far. Next up is Europe, bringing in about $9.5 billion. Pretty steady, no huge jumps, but also no major drops. Asia Pacific chipped in $8.2 billion, which is actually solid and shows the region's growing importance in digital ads. And last, we got rest of world at around $5.3 billion, definitely trailing behind the big markets. One thing to note, while first quarter 2025 dipped a bit compared to fourth quarter, normal since fourth quarter is always a shopping season boost, the year-over-year trend is up. Compared to first quarter last year, 2024, Meta's ad revenue jumped by over $13 billion. That's really good. Bottom line, Meta is still super strong in the US and Canada. Asia's rising, and the big question is whether they can squeeze more out of these smaller regions going forward. Here we've got Meta's total revenue breakdown by region. No surprise, the US and Canada are still carrying the weight, pulling in around $18.6 billion in this quarter. Solidly, the first market as usual. Europe holds steady too, bringing in about $9.7 billion, basically flat compared to last quarter. Asia Pacific came in at $8.4 billion, a small bump up, but you can see the steady climb as digital demands keep growing over there. And finally, rest of world clocked in at around $5.6 billion. Same pattern as always, a big gap between the core markets and the smaller regions. Compared to fourth quarter 2024, total revenue dipped a bit, totally normal with the post-holiday season drop-off. But year-over-year, massive growth from $28.6 billion in first quarter 2024 to $42.3 billion now. That's about 47 jump. Meta is still super dependent on the US, Canada, with Asia is showing real momentum. The big question, how fast can those small regions catch up? Alright, here's the breakdown for first quarter 2025. First up, family of apps, Facebook, Instagram, WhatsApp, etc. is still the powerhouse, pulling in around $41.9 billion, basically the entire company's revenue engine. Now let's talk about the Reality Labs, the division behind the VR or AR, and the whole metaverse push. Revenue, a tiny $412 million, practically no real movement from previous quarters. Minimal contribution but massive cost. And here's the red flag. Reality Labs posted an operating loss of $4.2 billion this quarter. Yes, again, years into this metaverse gamble and there's still zero proof that it's moving the needle. Compared to first quarter last year, no meaningful progress, same massive burn rate, same unanswered question about ROI. Meta's total operating income came in at $17.5 billion with a 41% margin. Solid overall. But let's be real, without the family of apps holding everything up, Reality Labs would be an enormous drag. Meta is placing a huge bet on the metaverse, but so far it looks more like chasing a mirage than unlocking a new growth engine. The big question, how long will Wall Street's patience last as Meta keeps storing billions into something that still feels like a black hole? This chart shows how Meta breaks down its spending across 4 key areas: cost of revenue, R&D, marketing and sales, and general administrative. For first quarter 2025, here's the snapshot. Cost of revenue held steady at 18%, basically flat from last quarter. Research and development jumped to 29%, up from 25% in fourth quarter 2024. marketing and sales stayed at 7%, general and administrative edge up to 5%. The standout, that spike in R&D. Why? External reports shed some light. First, heavy investment in AI and machine learning. Meta is going all in to catch up with OpenAI and Google, especially with its Llama. Mark Zuckerberg himself said they are retooling the entire tech stack around AI this year. Second, big infrastructure upgrades. Bloomberg reported Meta has been buying up tons of NVIDIA H100 GPUs to power its AI training. This hardware costs hit R&D hard. Third, the Metaverse push. Even though Reality Labs revenue remains tiny, the R&D spending for Metaverse projects like Quest 3 and Horizon Worlds is still lumped into this bucket. Meanwhile, the small bump in general and administrative costs, that's tied to Meta's global restructuring efforts, lingering legal and severance costs from last year's layoff according to the Wall Street Journal. Bottom line, Meta's keeping marketing and overhead lean, but its R&D spending is exploding. AI is the big bet right now, but the risk of runaway cuts is real. The question is, will these massive outlays actually pay off, or are we looking at another Reality Labs style money pit? In first quarter 2025, Meta's capex nearly doubled year over year, hitting around $13.7 billion versus $6.7 billion in first quarter 2024. This surge is no coincidence. According to Bloomberg, Meta has been aggressively ramping up data center expansion and infrastructure spending to support its AI ambition, especially the rollout of its next-gen AI chips and server clusters. Zuckerberg has been vocal about making Meta an AI-first company, and these costs are the price tag for that transformation. Despite the ballooning capex, EPS remains strong at $6.43 in first quarter 2025, down a bit from the holiday-fueled $8.02 in quarter 4 2024, but absolutely year over year. The steady climb over the past few quarters shows Meta's underlying profitability remains resilient even as investment pile up. Net income tells a similar story. $16.6 billion this quarter, slightly lower than the fourth quarter peak but well above the $5.7 billion reported in first quarter 2024. The upward trend is clear. Meta's core business is firing on all cylinders, powered mainly by the ad business, even as Reality Labs continues to drag on the bottom line. All of this financial paint a picture of strong momentum, but also rising financial commitments. Interestingly, Meta's effective tax rate dropped to just 9% this quarter, the lowest in the last 2 years. This has raised some eyebrows. According to CNBC, part of the reason is a favorable shift in international tax structures and certain one-time benefits from overseas subsidiaries, especially related to intellectual property allocations. However, analysts warn this low rate might not be sustainable long-term, as global tax reforms like the OECD's Global Minimum Tax Deal could kick in over the next year or two. In summary, Meta's financials look robust, strong profits, healthy EPS, and rising net income, while the company pushes aggressively on infrastructure and AI. But with soaring capex and a tax rate that might face headwinds soon, the next few quarters will test whether Meta can keep balancing heavy investment with profitability. At the end of the day, it's simple. Meta makes money from ads. The real deal? How good they are at turning users into cash. Let's check the numbers. Meta's ad business is still going strong, but the pattern is clear. More users, ad space is hitting its limit, so they are hiking ad prices to keep revenue growing. Smart move for now, but long-term Meta will need to sell better ads, not just more of them. Average price per ad year-on-year % change. Meta's been smart about squeezing more value in first quarter 2025. Global ad price jumped 10% year-on-year, with the US even stronger at 14%. Asia lagged behind a bit with just a 3% increase. Why the price hike? Because ad impressions are slowing down. Global growth was only 5% this quarter, way down from 20% last year. The US and Europe were flat at 4 up to 5%, and even Asia cooled to 9%. Put together, this drove ARPP to $12.36 in first quarter. It's down from the fourth quarter holiday spike of $14.25, but still up from last year's first quarter. Seasonal dip aside, the long-term trend is edging higher. At the base that keeps it all going, Meta's user count hit 3.43 billion in first quarter, up from 3.02 billion a year ago. Growth is still solid, mostly driven by developing markets. Alright, now let's get into the fun part. What's Meta's fair value really at? I'm using the discounted cash flow method, which is the go-to approach for valuing a giant like Meta. The base number here is Meta's latest free cash flow in first quarter 2025. They pulled in around $10.3 billion. WACC basically measures Meta's risk and the cost of its capital. For big tech companies like Meta, analysts typically use something between 6 and 8%. I'm going with 7% because it's in line with what major analysts like Goldman Sachs and Morningstar use. Meta is a cash machine, but there are still real risks. Data privacy regulations, heavy reliance on ad revenue, and the metaverse bets that haven't paid off yet. So 7% feels balanced, not too bullish, not too bearish. Terminal growth is the long-term rate at which we expect Meta to keep growing after 5 up to 10 years. Normally, this is tied to the economy's long-term growth. 2.5% is a conservative goal, roughly matching US inflation and long-term GDP growth. 3% is a bit more optimistic, reflecting Meta's potential to drive the growth through AI, WhatsApp monetization, and other fresh revenue streams. So I'm using a 2.5% to 3% range to cover both realistic and slightly bullish scenarios. With a 7% WACC and 3% terminal growth, Meta's fair value lands around $415 per share. That's noticeably lower than its current market price, which is sitting north of $500. Bottom line, Meta's fundamentals are rock solid. But valuation-wise, the current price looks a bit rich if you stick to realistic assumptions. Unless Meta can seriously ramp up FCF for the market start viewing it as ultra-safe, WACC less than 6%, the stock's trading at a premium right now. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. I'll see you in the next one.